What's up, everyone? Welcome to another Loose Ventures video. I hope your week is going well. Today, I wanted to take a look at a cybersecurity stock. So that would be Palo Alto, which is one of the industry leaders and the largest standalone cybersecurity stock publicly traded company in the world. So what they do is just high level. I'm gonna keep it high level because let's face it, most of us don't understand a lot about cybersecurity software in the first place. Kind of like that guy that was talking about Upstart on CNBC last year. But yeah, so they provide firewall and security software globally, and they've been doing a pretty good job. So the company has a good track record. Been around since, I believe they were headquartered in 2005. Let's check ticker here. 2005. So they got a pretty good track record. They've been growing a lot, and they're in a good industry, I think. So without saying anything further, let's go right into estimates. So we'll start off, as always, with estimates for our financials analysis. And as always, I want to look at revenue, EBITDA, as a proxy for earnings, and free cash flow. So I'm going to be focusing on revenue and free cash flow for this one, mind you, because it's something a bit weird about EBITDA, which I'll talk about in a minute. So revenue, we got 36 estimates for a 22% increase for next fiscal year. For the current fiscal year, which ends July 31st of next year, we got 24.5% increase. So we're looking pretty good. We got a good track record of revenue growth. Cybersecurity is just, a lot of tailwinds for this industry. So this company's been, they've been doing pretty well despite all the competition. Free cash flow, we have 23 estimates for $2.9 billion for next fiscal year, about $2.4 billion for the current fiscal year. So we're looking pretty solid there. So a couple years of really solid growth, especially coming out of COVID. So they seem to have hit their stride with free cash flow growth for sure. So estimates are looking good. Let's take a look at let's look at some historical consistency. So if we look at the long term, that was a ticker.com, mind you, and just looking at estimates. And now we'll go to ROIC.ai. As always, these are free resources for everyone to use. ROIC.ai, we could look at long-term revenue growth and margin growth. And if we look at revenue, the brown bar here, it's just growing like crazy. So big check mark there. Always like to see very high revenue growth. It's been in double digits, I think, since inception, I believe. So just year over year. So really strong revenue growth. We won't look at EBITDA because they are spending a lot of money in R&D, and there's a lot of stock-based compensation, which I don't like. But I'll talk about why I'm kind of okay with it for this company in a minute. So if we look at gross margins, those are looking pretty solid, above 70% every year since going back to 2011 up until this year, this previous fiscal year. A little bit of margin pressure, but still close to 70% on gross margins. So that's looking okay. So now we got free cash flow, and we already looked the past couple of years looking great. But yeah, that's just been growing in line with revenue, in line with margins as well. So decent, just consistent growth for the past over 10 years. So looking pretty good so far. Let's take a look at the balance sheet, and then we'll move on to our risk analysis. So a couple things on the balance sheet. I like to check the box on liquidity, and here they do have unearned revenue that goes out past 12 months. Now that kind of messes with the cash flow, with the balance sheet, how revenue is recognized, but that's just how it goes for their business model. If this was a brand new company, I would be very cautious on that. But either way, I still don't like to see it. But since it's a long-standing company, they got a good track record, or long enough, right, since 2005. They've been doing very well. Let's just say I trust them. However, their liquidity isn't the best. I like to see current assets higher than current liabilities, but the business is working, and they do have good free cash flow generation. So they don't get the big green check mark that I would give for net working capital, which is just current assets minus current liabilities. But their liquidity it does look fine. They do have some share issuance year over year, which can be explained by the stock-based compensation, which is there is a lot. So if we go to the statement of cash flows, let's check that debt real quick. Total debt about $4 billion. So $4 billion rather than compared to EBITDA, which is pretty low given their high marketing and R&D expense. I like to compare it to free cash flow for a growth company like this, where EBITDA doesn't really serve as a good proxy. So $4 billion in debt versus $2 billion in about $1.8 billion in free cash flow for the past 12 months, the prior fiscal year, rather. And then compare that $4 billion in debt to $2.4 billion expected this fiscal year and $2.9 billion expected for the next fiscal year. So it's looking pretty good. Free cash flow is expected to be more than half of debt, which is very nice. You can't say that for too many companies. So I'll give them a pass on leverage. That's pretty low leverage. So as we can see right here, there's this big stock-based comp figure, which I don't like. And this is historically, it's about 20% of annual sales. Typically, I don't want it to be above 5%. This isn't a good thing. I'll include it as a downside risk. I just don't want to see stock-based comp that high. But if this company wasn't a long-standing company, didn't have a really good track record, then I'd scratch it off. But because they do have a good track record, we'll give them a sort of a pass, I guess. I don't want it to remain this high, frankly, as a long-term investor. All right, so that's financials. Let's take a look at the risks. Okay, so upside risk. Palo Alto is they're the biggest in cybersecurity in the world. So they're an industry leader. They have low leverage, less than 0.8 times debt to free cash flow, which is very nice, and almost no net debt if you're using that metric. And they have decent liquidity, including their cash position in the $400 million revolving credit facility, which is just like a credit card, versus a $12 billion balance sheet. So I think they're well equipped for the industry, right? It's pretty competitive. Number two, revenue and free cash flow growth is still expected to be double digits through fiscal year 2024. So not just this current fiscal year, but next year as well. So that's pretty strong, and that's because we have some good industry tailwinds going. All considered, it's going on in the world, right? The business, number three, is somewhat recession resilient. Emphasis on somewhat. I don't think any company is fully recession resilient, but high geopolitical risk. Spending is not going down. Expenses are considered defensive when it comes to cybersecurity. Valuation, number four, prices in a moderation of growth versus high growth. So while I wouldn't say this is a strictly speaking a value stock, I think it's fairly valued. I think it's reasonable to say added to a long-term portfolio at these prices. And if they can prove the resiliency through a recession, the stock price should reflect some good investor confidence. Maintain that high growth and good free cash flow, right? All right, downside risks. Number one, obviously macroeconomics. Global recession, doesn't matter what company it is, it could always slow revenue growth. But it's going to be the same for every single stock, right, at this point. Competition. This is a highly competitive industry. They're going to have to keep those costs high for marketing and R&D, so limits the potential margin expansion. Stock-based comp, approximately 20% of same-year sales over the past several years. So if they shift from stock-based comp to cash expense for their employees, margins and free cash flow will be negatively impacted. Impact should be limited, however. Something I do want to know, I wouldn't say it just precludes this from being a risk, but if greedy executives, they decrease stock-based comp for themselves, true cash flow generation will increase and could offset otherwise increased employee expenses. So This is definitely a downside risk. Nobody likes dilution. Nobody likes a lot of stock-based comp. Well, a lot of people did over the past several years, but I think it's kind of evident now that very high stock-based comp does not make for a good long-term investment. All right, so financials are good. Risk analysis, we got some decent upside risk, I think, and then we got some downside risk to be cautious of. So let's take a look at valuation next. All right, so here, as always, I included some comps that I think should be considered, not just cybersecurity. I rolled out some cybersecurity stocks that, frankly, they're just not valued as well or don't have the same amount of growth. Also included other companies that I recently analyzed, like Meta and Google. And then I threw in some mega cap stocks just to kind of give you some more companies to compare them to. There's Intuit, a big software as a service company, and there's AMD, which I also covered recently. And each one kind of has a purpose here, you'll see. So revenue growth. Revenue growth is pretty high, 35% forward 3-year CAGR for revenue growth, and it's just been over 20%, right? So it's looking very strong. You can compare that to one of their peers, Fortinet, and then CrowdStrike has this ridiculous revenue growth, right? Next, I want to look at, let's see. So revenue growth, definitely, big green check mark there, yeah. So next, we're going to focus on enterprise value to sales and free cash flow yield. So enterprise value to sales, you can compare that 5.4 times on a forward basis. So this is based off of 2024 estimates, which I went ahead and populated here. So you can compare that to other stocks. You compare that to their comps. They have similar growth to Fortinet. I think it's slightly higher, actually. So we're looking a little bit better than Fortinet, at least going forward. Priced relatively better than Fortinet, and definitely better than CrowdStrike. CrowdStrike does have that high growth, but this is just one metric to look at, and then you can see how that 5.4 times holds up to the rest of these other comps. Free cash flow yield 6.4%, pretty good. My personal hurdle rate is 5%, and I always like to have a bit of a margin of safety on top of that. So 6.4% compares well with all these other companies we're looking at. And that's it's still lower than Meta and Google, right? Which I've covered. AMD is comparable, but cybersecurity doesn't come with the same value trap risk that semiconductors have, right? And if you remember, AMD for me is I was thinking about selling puts at strike 50, so we're getting a little close to that price level, but it's all going to depend on how things pan out for these next few earnings seasons, right? So yeah, Palo Alto, I think they're priced reasonably well at this level. I might be dollar cost averaging into them. I am trading them, mind you, but yeah, I think it's a good long-term hold. I think they have good tailwinds for in the industry. I even included some stock issuance here to kind of see what the impact would be on the share price. So this is always going to be forward-looking. I like the free cash flow yield. It's priced reasonably looking at enterprise value to sales. 5.4 times. I mean, it was at above 10 times for a while, right? So I think it's looking pretty good. Okay, so looking at the options for Palo Alto, if we look at covered returns, right here at the money, which resembles the annualized return of selling these options relative to the stock price, we have about 22% and 23% for at-the-money calls going out to June. And compare that to about 18% and 19% for the at-the-money puts going out to June. So there's a bit of a premium there. So 22, 23%. Bit of a premium there going out to June. It implies some bullish sentiment, at least when looking at the options prices, which maybe makes sense at this point, right? And the same can be observed for January as well. Cover returns 33 and 36% versus 29 and 32% for at-the-money calls versus puts, right? So I like having leverage. I do have the Junes. I'm going kind of bigly here, strike 200. So I'm pretty bullish on Palo Alto, but I am selling short puts, which are in the money currently. But that's okay. I don't mind. I can roll those. But yeah, I do like getting leverage. just know that you're going to be paying a bit of an extra premium for those calls relative to the puts. But if you're very bullish on Palo Alto, then perhaps it's worth it. I always like a nice dollar cost averaging strategy, just in case the current price level isn't exactly where you want it to be at. No problem being conservative, right? So, I think that about covers it for Palo Alto. So, we covered financials, which it's a big emphasis on revenue growth, free cash flow growth, which I think is, people are very much in desire of, given where the markets are, right? So imagine a company that's still growing over 20% through potential, or we're probably going to have a recession, right? But yeah, this company should still do well even through a recession. I think there's a fat chance that this 24% revenue growth drops, to near flat growth. I think things will have to be very bad for that to be the case, and then forget any of these stock picks, right? So I think they're going to do well even through a global economic downturn, right? So financials looking pretty good. Leverage is nice and low, at least when you compare debt to free cash flow. And liquidity is decent as well. $4 billion in liquidity versus $12 billion balance sheet. Risk analysis, I think the upside risk more or less offset the downside risk. I think I'm okay with this. Stock-based comp, I don't like it, but let's just say I hope they lower it, right? But again, you can always dollar cost average, and so hopefully they ease up on that stock-based comp, and then valuation, they're looking decent. I mean, a high growth stock that's some people are just buying this stock at this price, right? I always like to be conservative, so. Frankly, I'd like to lower my cost basis as much as I can. But yeah, dollar cost averaging also isn't a bad way to go about it. So yeah, financials look good. Risks, I think, are okay. Valuation looks good. And maybe a good stock to dollar cost average into. So yeah, that's all I got to say about Palo Alto. Again, high level overview. I like to let the numbers speak for themselves. Yeah. So if you have any questions or comments, let me know down below. And if you haven't already, check out some of the other videos. I've covered Google, Meta, AMD, Stellantis, and a few other longer videos if you're curious about those. So yeah, thanks for tuning in, and until next time, cheers.